Everyone's watching the stock market, the S&P 500, the Dow, the NASDAQ, waiting for the crash, predicting the top, analyzing every 2% dip like it's the beginning of the end. But here's what they're missing. When the next financial crisis comes, it won't start in stocks. It never does. The stock market crash is the finale, not the opening act. It's what happens after the real damage is already done. And right now, in January 2026, the real damage is happening in markets most people never think about. Markets that are larger, more interconnected, and far more dangerous than the stock market could ever be. This is the story of where crashes actually begin, and why the warning signs are already flashing, and why the bond market, commercial real estate, and consumer credit might take down the entire system before stocks even know what hit them. Let me show you something. In 1929, everyone remembers Black Tuesday, October 29th, when the stock market crashed and the Dow lost 25% in 4 days. What they don't teach you is what happened before. In the spring and summer of 1929, the commercial real estate securities market had already collapsed. Real estate bonds, which accounted for 23% of all corporate debt issued in 1925, were in free fall by 1928. The skyscraper boom of the 1920s had been financed with mortgage-backed securities, the same kind of financial innovation that would reappear 80 years later. By September 1929, these securities had lost half their value. Banks holding them were already insolvent. They just hadn't admitted it yet. The construction financing had dried up. Commercial property prices were dropping. And then, in October, when margin calls hit the stock market, those same banks couldn't provide liquidity because their balance sheets were already destroyed. The stock crash didn't cause the crisis. It revealed the crisis that was already underway. Fast forward to 2008. Everyone remembers Lehman Brothers collapsing on September 15th. The stock market panic, the 50% crash. But the real crisis had started 18 months earlier. In February 2007, subprime mortgage lenders started going bankrupt. New Century Financial, one of the largest, filed for bankruptcy in April 2007. Bear Stearns hedge funds that invested in mortgage securities collapsed in July 2007. By August 2007, the asset-backed commercial paper market, worth $1.2 trillion, had frozen. No one would buy mortgage-backed securities at any price. The credit market seized up a full year before anyone cared. The stock market actually rallied through most of 2007. The S&P 500 hit an all-time high on October 9, 2007, nearly 5 months after the mortgage crisis began. The banks were already dead. The credit system was already broken. Stocks just hadn't gotten the memo yet. When Lehman collapsed a year later, it wasn't the cause of the crisis. It was the symptom that finally forced the stock market to acknowledge reality. The pattern is always the same. The crisis begins in the credit markets. Bonds, loans, securitized debt, the things that don't make headlines, the markets that most people don't understand and don't follow. Credit tightens, defaults rise, liquidity dries up, and then only after the damage is done, after the banks are exposed, after the contagion spreads, the stock market crashes. And that's when everyone notices. That's when the media pays attention. But by then, it's too late. The opportunity to protect yourself was months, sometimes years, earlier when the credit markets were sending the warnings. And right now, at the start of 2026, those warnings are screaming. Let's talk about the bond market. $30 trillion in outstanding debt. That's not a typo. $30 trillion. More than the entire U.S. stock market. More than the GDP of the United States. And it's been in the process of a historic collapse. From January 2021 through 2025, the 10-year Treasury yield went from 1.5% to over 4.5%. That's a 200% increase in just 4 years. And when bond yields rise, bond prices fall. For every 1% increase in interest rates, the U.S. government's annual interest payments increased by $250 billion. We're now paying over $1 trillion per year, just in interest on the national debt. More than we spend on defense, more than we spend on Medicare. Just interest. And it's still accelerating into 2026, but here's what makes this terrifying. This isn't just a U.S. problem. In April 2025, something unprecedented happened. Both stocks and bonds crashed at the same time. When Trump announced sweeping tariffs on April 2nd, investors started selling everything. Stocks, yes, but also Treasury bonds. In normal times when stocks fall, bonds rally. Investors flee to safety. Treasury yields drop. That's the pattern that's held for 40 years. It didn't happen. Instead, the 10-year Treasury yield spiked from 3.9% to 4.58% in a week. The 30-year yield surged 54 basis points in 3 days, the biggest jump since 1982. Foreign investors were dumping U.S. bonds, central banks were selling treasuries, the flight to safety reversed. For the first time in modern history, U.S. government bonds were being treated as a risk asset, not a safe haven. That's not a correction, that's a paradigm shift. And it got worse. Moody's downgraded the U.S. credit rating in May 2025, stripping away the last 808 rating the country had. The market's response? Bond yields surged again. The 30-year Treasury yield broke above 5% for the first time in over a decade. What does this mean practically? It means borrowing costs have exploded. Mortgage rates are hovering near 8%. Business. Loans are expensive. Credit card rates are at 24-25%. And most importantly, the refinancing wave that hit throughout 2025 and continues into 2026 is crushing a debt market that can barely function. Here's the mechanism of failure. The U.S. government needs to roll over trillions of dollars in maturing debt every year. When interest rates were at 2%, that was manageable. Now rates are over 4.5%. Every bond that matures and gets refinanced costs more than twice as much. The deficit explodes. More bonds need to be issued. But who's buying? Foreign central banks have been reducing their Treasury holdings. China has been selling for years. Japan, facing its own fiscal crisis, has pulled back. The traditional buyers are leaving. And the Federal Reserve, which was the buyer of last resort during COVID, spent most of 2024 and 2025 selling bonds, not buying them, through quantitative tightening. The demand is gone. The supply is increasing. And when that dynamic takes hold fully, when a Treasury auction fails or yields spike to levels that force the government into emergency measures, the feedback loop accelerates. Higher yields mean higher debt service. Higher debt service means more borrowing. More borrowing means more supply. More supply with less demand means even higher yields. It's a death spiral. And we're already in it as we enter 2026. While the bond market is cracking, commercial real estate is exploding. Throughout 2025, the crisis accelerated. By the end of the year, over $950 billion in commercial real estate loans had matured. Another $930 billion matures in 2026. And here's the catastrophe. Most of the 2025 maturities couldn't be refinanced. They were extended, restructured, or defaulted. This is what industry insiders call the maturity wall. And as we start 2026, the wall is crumbling. Here's why. When these properties were financed in 2019, 2021, interest rates were at historic lows. 10-year Treasury yields were around 1.5 to 2%. Commercial mortgage rates were 3-4%. Property values were high. Everything worked. Now, those same loans need to be refinanced. But rates are 6.5, past 7%. Property values have dropped 20-40% in many sectors. The math doesn't work anymore. A building that was worth $100 million in 2021 might be worth $65 million today. The loan against it is still $70 million. And the new interest rate is double. The debt service coverage ratio collapses. Banks won't refinance. Owners can't pay. The office sector is a complete disaster. National vacancy rates hit 20% in 2025. In Manhattan, office building delinquency rates jumped 1,000% from January 2023 to January 2025. Remote work destroyed demand, companies downsized, buildings are half empty, and many of those buildings are financed with loans that are now deeply underwater. Commercial mortgage-backed securities, or CMBS, showed a delinquency rate of 7.29% by late 2025, nearly 6 times higher than traditional bank loans. Over $21 billion in CMBS office loan balances matured through 2025 and into 2026. Among loans that have already matured and haven't been paid off, 83.7% are delinquent and 92.7% are in special servicing. That means they're in default. The lenders are trying to work them out. But there's no solution when the property is worth less than the debt and cash flow doesn't cover the payments. And it's not just offices. Retail is struggling. Hotels are stressed. Even multifamily is showing cracks as rent growth stalls and operating costs surge. The extend and pretend strategy that worked in 2023 and 2024, where lenders gave borrowers more time hoping for conditions to improve, ran out of road in 2025. You can only extend a loan so many times before reality catches up. When defaults hit throughout 2025, they started cascading. Regional banks are the most exposed. Many of them have commercial real estate loans making up 50% or more of their assets. When those loans go bad, the banks fail. We saw this in March 2023 with Silicon Valley Bank, Signature Bank, and First Republic. All three collapsed in 1 week because of liquidity crises related to rising rates and underwater bond portfolios. That was just the preview. The commercial real estate losses hit hard in 2025 and are accelerating into 2026. As the maturity wall reaches its peak in 2026 and 2027, dozens more banks will fail. The FDIC has been preparing. S&P Global has identified 278 banks as vulnerable due to commercial real estate exposure. Throughout 2025, we saw the first wave. 2026 will be worse. But here's what connects this to the broader system. When regional banks fail, credit tightens everywhere. Small businesses can't get loans, construction stops, The real estate market freezes. And because commercial real estate is collateral for trillions of dollars in other financial instruments, derivatives, structured products, pension fund investments, the losses spread. Pension funds that own CMBS took massive hits in 2025. Insurance companies holding commercial mortgages are facing solvency issues heading into 2026. The shadow banking system, which has financed much of the commercial real estate boom through private credit funds, saw redemptions and fire sales throughout 2025. This isn't contained. This is systemic. And then there's consumer credit. Credit card debt in the United States hit $1.21 trillion by the end of 2025, an all-time high. That's up 60% from 2021. Average credit card debt per household reached $7,321, up nearly 6% year over year. But it's not the total that matters. It's the delinquencies. Credit card delinquency rates rose steadily throughout 2024 and 2025. By the fourth quarter of 2025, the delinquency rate in the lowest income zip codes hit 23.5%, up from 14.9% in 2022. That's a 58% increase in 3 years. Even in high income areas, delinquency rates doubled through 2024-2025. The 90-day delinquency rate, which measures accounts that are seriously past due, reached levels not seen since the 2008 financial crisis. And here's the shocking part. This happened while unemployment remained at historic lows through most of 2025. The labor market was strong. People had jobs. They were still defaulting. Why? Because the cost of living exploded. Inflation may have slowed, but prices haven't come down. Groceries cost 30% more than they did 3 years ago. Insurance premiums skyrocketed. Rent is up. Utilities are up. Everything is more expensive. And wages, while rising, haven't kept pace. The result is that millions of Americans are using credit cards not for discretionary spending, but for essentials. Groceries, gas, utilities, and they can't pay it back. The average credit card interest rate hit 24-25% by late 2025. At that rate, if you're carrying a balance, you're drowning. A $10,000 balance at 24% interest costs you $2,400 a year, just in interest. Most people are making minimum payments and watching their balances grow. This is a death spiral at the household level. And as we enter 2026, it's breaking fast. Student loan delinquencies surged in 2025. The serious delinquency rate jumped from 0.53% in Q4 2024 to 7.74% in Q1 2025 and continued climbing through the year. Auto loan delinquencies throughout 2025 were worse than they were during the financial crisis. Subprime auto delinquencies pushed past 6%, literally higher than the 2009 peak. Car repossessions hit 2.2 million in 2024 and accelerated in 2025. These aren't fringe issues. These are mainstream consumer credit products showing severe stress. And when consumers default, banks take losses. Credit card charge-offs rose throughout 2025. Auto lenders got crushed. The banks that issued these loans, especially regional banks heavily exposed to consumer credit, are sitting on ticking time bombs as we begin 2026. So why does all of this matter more than the stock market? Because the stock market is the last domino to fall, not the first. Credit markets are the foundation of the entire financial system. When credit fails, everything fails. Here's the chain of events. Rising bond yields destroy bank balance sheets. Banks hold trillions in treasury bonds and mortgage-backed securities. When yields rise, those bonds lose value. Banks are sitting on massive unrealized losses. As of the end of 2025, U.S. banks were holding over $500 billion in unrealized losses on securities. That's money they've lost on paper. It doesn't matter until it does. If depositors get nervous and start withdrawing money, banks have to sell those securities at a loss to raise cash. That's what killed Silicon Valley Bank in 2023. Selling at a loss makes the losses real. Capital gets wiped out. The bank fails. When banks fail, credit disappears. No one can borrow. Businesses can't operate. Consumers can't spend. Economic activity grinds to a halt. Commercial real estate defaults accelerate bank failures. When commercial real estate loans go bad, banks take direct losses. A $50 million loan on a building now worth $30 million means a $20 million loss. Multiply that across thousands of properties and dozens of banks. Regional bank failures began cascading in 2025. Larger banks, seeing the contagion, tightened lending standards everywhere throughout the year. Credit became scarce. The economy contracted. Consumer credit defaults pushed banks over the edge. Credit card and auto loan charge-offs ate into bank profits throughout 2025. When combined with bond losses and commercial real estate defaults, regional banks couldn't survive. And when they fail, the FDIC has to step in. But the FDIC's insurance fund is only about $125 billion. If dozens of banks fail in quick succession in 2026, that fund runs out. Then what? Government bailouts, money printing, confidence collapses. And here's the critical point. Stocks don't crash until investors realize the banks are in trouble. The stock market can ignore bad news for a long time. It did in 2007. It rallied while subprime lenders were collapsing. But eventually reality catches up. When major banks report losses, when credit freezes, when GDP contracts, when earnings collapse, that's when stocks crash. Not before, after. The bond market is the early warning system. Bond yields spiking in 2025 was the canary in the coal mine. Commercial real estate defaults throughout 2025 were the fire starting. Consumer credit failures in 2025 were the accelerant. And as all three intensify in 2026, when the credit system seizes, the stock market doesn't just correct, it collapses, 50% down, maybe more. Because at that point, the entire financial system is on the verge of failure. That's what happened in 2008, that's what happened in 1929, and that's what's setting up right now. Here's what makes 2026 so dangerous. All three crisis vectors that built through 2024 and 2025 are now converging simultaneously. The bond market came under severe stress in 2025. Treasury yields elevated. Foreign buyers pulled back. The deficit exploded. Debt service costs skyrocketed. This is now the baseline reality as we enter 2026. The commercial real estate maturity wall peaked in 2025 and continues through 2026, 2027. Nearly $2 trillion in loans coming due over these years. Many couldn't be refinanced in 2025. Defaults surged. Banks failed. The crisis is locked in and accelerating. Consumer credit broke throughout 2025. Delinquencies rose every quarter. Charge-offs accelerated. Household balance sheets maxed out. This trend worsened through all of 2025, not improved, and is continuing into 2026. Unlike previous cycles, where these crises happened sequentially, giving the system time to adjust, this time they're happening together. Banks faced bond losses, commercial real estate defaults, and consumer credit failures all through 2025. They don't have the capital to absorb all three. The Federal Reserve doesn't have the room to maneuver. Interest rates are still elevated. Inflation, while lower, is still above target. If they cut rates aggressively to save the banks, inflation could roar back. If they hold rates high to fight inflation, the credit crisis accelerates. They're trapped. The government doesn't have fiscal space either. The deficit hit $2 trillion in 2025. Debt to GDP is 124%. If a crisis hits in 2026 and they need to bail out banks, stimulate the economy, support the unemployed, the deficit explodes to $4 or $5 trillion. At that point, bond yields spike further. The debt spiral accelerates. There's no easy way out. The trigger could come from anywhere in 2026. A failed Treasury auction, a major bank failure, a wave of commercial real estate foreclosures, a spike in unemployment, a geopolitical shock. The system is so fragile that any of these could set off the cascade. And once it starts, it feeds on itself. Bank failures cause credit to freeze. Credit freezing causes defaults to spike. Defaults spiking cause more bank failures. It's a feedback loop. And at some point in that loop, the stock market wakes up. Investors realize that corporate earnings are about to collapse because the economy is collapsing. They start selling. And when the selling starts, it doesn't stop. Because by then, margin calls hit. Leveraged investors are forced to sell. Algorithmic trading accelerates the decline. The VIX explodes. Circuit breakers trigger. And within weeks, the stock market is down 30, 40, 50%. The crash everyone was watching for arrives. But it arrives last, not first. So what do you do with this information? First, understand that this is not about timing the stock market. You cannot time the stock market. No one can. What you can do is recognize vulnerability. Right now, as we start 2026, the credit markets have been flashing red for over a year. That doesn't mean stocks crash tomorrow. It means the foundation has been cracking. When the foundation cracks, the building eventually falls. It's not a matter of if, it's a matter of when. And the when is likely measured in months, not years. Second, understand that diversification into stocks and bonds won't save you this time. That strategy assumes bonds go up when stocks go down. But we saw that break in April 2025. Both crashed together. If that becomes the new pattern, and all signs suggest it already has, a 60-40 portfolio gets destroyed. You're not diversified. You're doubly exposed. The traditional playbook doesn't work when both asset classes are in crisis. Third, understand where the real risk is concentrated. If you're holding regional bank stocks, you're sitting on a powder keg. If you own REITs, heavily exposed to office or retail, you're exposed to the commercial real estate collapse. If your portfolio is loaded with high-yield corporate bonds, you're in the blast radius when credit spreads blow out. Risk is not evenly distributed. It's concentrated in specific sectors that are directly in the path of the credit crisis. Fourth, understand that cash, despite inflation, is not the worst position when a credit crisis unfolds. When everything crashes simultaneously, the best position is liquidity, the ability to wait, the ability to not be forced to sell, Having cash when asset prices collapse is how generational wealth is built. Those who have liquidity during a crisis can buy assets at 30, 40, 50 cents on the dollar. Those who are fully invested and leveraged get wiped out. And finally, understand that the warning signs have been here throughout 2025. Roger Babson warned about the 1929 crash months in advance. He was mocked. He was right. The bond market has been warning us for over a year. Commercial real estate has been warning us. Consumer credit has been warning us. The question is whether we're listening. Most people won't. They'll stay invested because the market is near all-time highs. They'll trust the experts who say everything is fine. They'll believe the narrative that the economy is strong, the Fed has it under control. This time is different. It's never different. The pattern is always the same. The credit markets break first, the banks fail next, and the stock market crashes last. By the time you see it on CNBC, by the time your friends are panicking, by the time the headlines are screaming, it's too late. The damage is done. So here's the summary. The next financial crisis won't start in the stock market. It has been building in the bond market, where $30 trillion in debt repriced at much higher yields throughout 2024-2025, destroying bank balance sheets and exploding government debt service costs. It has been accelerating in the commercial real estate market, where nearly $2 trillion in loans have been maturing since 2025, and most can't be refinanced, triggering a wave of defaults and bank failures. And it has been amplified by consumer credit collapse, where credit card, auto loan, and student loan delinquencies reached crisis levels throughout 2025 and continue rising, pushing regional banks toward insolvency. These three forces converged throughout 2025, not in the future. They happened. And as we enter 2026, they're intensifying. When the defaults cascade further, when more banks fail, when the credit system seizes, the stock market will crash. Not as the cause, but as the effect. The finale, not the opening act. The pattern has played out twice before in modern history. In 1929, the commercial real estate securities market collapsed first, then banks failed, then stocks crashed. In 2008, the subprime mortgage market collapsed first, then banks failed, then stocks crashed. In 2025, 2026, the bond market, commercial real estate, and consumer credit are collapsing together. The banks are failing, and the stocks are next. The script is already written. The actors are already on stage. The only question is how fast the final act unfolds. If you understand this pattern, if you recognize the warnings, you still have time. Not a lot of time, but enough to prepare, to reassess your portfolio, to build liquidity, to position yourself not for the world you wish existed, but for the world that's coming. Because the biggest market crash won't start in stocks. It will end there. And by the time everyone notices, it will be too late to do anything but watch.